How to do the valuation of banks and financial institutions. Namaskar, hello and welcome friends to this advanced financial modeling, stock research and valuation course. This course is for investors and finance students who are looking to understand how professionals value stocks. The course comes with a dual certification program. One is for the course completion and one is for internship completion. So, for those who are interested in enrolling to the course certification program, the details are given in the description and in the end of the video. You can check that out. Meanwhile, the entire course material is available freely on YouTube, like this video, so you can learn it freely anywhere, anytime. Students who are pursuing courses like MBA Finance, CFA, CA, CPA, MCOM, BCom have all taken this course and benefited from it. If you are an investor or if you are a finance student, this course is for you if you are looking to understand how professionals value their stocks. What is the eligibility for this course? The good news is we have structured the program assuming that the viewer is a beginner. So, from a beginning stage, if you do all the assignments and all the chapters one by one without skipping them and applying them hands on, then by the end of this course, you are assured to have an advanced level knowledge of how stock valuation is being done. And regarding the course content, let us discuss that now. First, we come to the stock filtration. Any stock exchange, if you visit, you will find that there are thousands of stocks. For example, Nasdaq has more than 3,000 stocks. NSE and BSE together have around 8,000 stocks. So, to begin with, we need to find out a way where we can filter out all these thousands of stocks and reduce the number to a manageable list which we can do deep analysis on. In the first assignment and first chapter, we show you an efficient way, an intelligent way of segregating the stocks and filtering them out. In the second chapter and second assignment, we try to understand how to interpret the cash flow statement, the balance sheet, and the income statement and bring them together to do ratio analysis. Ratio analysis brings us to chapter 3 and assignment 3. In chapter 4, assignment 4, we are going to study together in a detailed way how to do discounted cash flow valuation. Apart from that, we will also learn how to do dividend discount model valuation and residual income valuation. After learning how to do discounted cash flow valuation, we get into detailed reading of an annual report. We take a company which is listed in the stock markets and we read the annual report together along with you. After learning discounted cash flow modeling and valuation, we move into valuation of financial institutions, that is, banks, NBFCs, etc. The valuation of banks and financial institutions is a bit different than the typical manufacturing company or even an IT company. So we understand how to mathematically value a bank or a financial institution in this assignment. This is assignment 6, chapter 6. Assignment 7, chapter 7 is about understanding the monetary system and the currencies. We delve deep into the history of monetary system, the evolution of currencies, and the impact of central banking policies and the state's financial and monetary policies on the economy, especially during recession times. In the last chapter, that is assignment 8, chapter 8, we move into understanding the specific analytical parameters for specific industries and specific companies. For example, a mining company is analyzed differently than a retail company. A retail company is analyzed differently compared to an IT company. An IT company is analyzed differently compared to a banking company. So specifically, each of these industries have some specific parameters. We understand what those parameters are and how to understand them in this last assignment. And once all these things are over, the main goal is for you to become capable of valuing stocks like professionals do and creating reports like professionals do. So without further ado, let's get started. How to do the valuation of banks and financial institutions. Chapter 6, Assignment 6 of Advanced Financial Modeling, Stock Research and Valuation course and internship is all about that. Here we select a real listed banking company and calculate its free cash flows and intrinsic valuation hands on. Let's get started.
So friends, in this assignment we are going to understand how to value financial service companies. And we will do that through the valuation of companies like HDFC Bank Limited. And we will do that through the valuation of HDFC Bank to start with. Valuation of financial services, HDFC Bank. So friends, if you look at the valuation, the ways the valuations can be done, There are multiple methods. There is discounted cash flow method, which uses free cash flow to the firm. There is enterprise value method. There is residual income method. There is discounted cash flow method, which uses free cash flow to equity. Then there is the dividend discount model. Now friends, out of these 5 methods, 2 of the methods we are not able to use because of the nature of a financial service company. So first let us understand what is the nature of a financial service company. Now, a financial services company, what it does is, it buys debt at low cost or low interest and sells it at a higher cost or higher interest. Let's say a bank borrows at 4% and it lends at 10%. In between, the bank has costs which amounts to 3% of the total debt it takes on. So for a bank, debt is like raw material. They are buying it at 104. They are creating a finished product at 107 and they are selling it at 110, thereby keeping a margin of 3. So debt for a bank does not behave like a traditional capital. It behaves more like raw material. Therefore, the valuation methods which use debt as a pure play capital cannot be used in valuing a bank or a financial service company. Now, the valuation methods which use debt as pure play capital are DCF of free cash flow to the firm and enterprise valuation. How? Let me tell you. So DCF through free cash flow to the firm. How we value this? First, what we do is we find out the projected cash flows for 10 years, right? Then we find out the terminal value of free cash flows. Then what we do? We find out the present values of all these cash flows, the terminal values and the 10-year cash flows, and then we sum them up. Once we sum them up, what we get is the intrinsic value. But there is a problem, friends. The formula for FCFF, that is free cash flow to the firm, uses interest rate as a capital. So the FCFF is given by net income plus non-cash charges like depreciation and amortization minus increase in working capital expense minus increase in capex plus interest. Now here lies the problem. We are using interest as a capital flow. Because in case of a bank, debt behaves like raw material, interest is basically more like an inventory cost or a product manufacturing cost. So you cannot use this, which effectively means that we will not be able to use the free cash flow calculations and the DCF calculations through free cash flow method. So this will not be possible. So this method is out of our equation. Okay. Then comes the enterprise value method. Friends, here the valuation is simple. It is market value of equity plus market value of debt minus cash. You can see in bold and simple letters, we are using debt as a pure play capital in this valuation method also. Again, I'll repeat, in case of a bank, because debt does not behave like a pure play capital, enterprise value method cannot also be used. So what are the valuation methods remaining? We have residual income method, we have DCF through free cash flow to the equity, and we have dividend discount model. Now, residual income we can use, dividend discount model we can use because they are pertaining to net income and equity. we can only use equity as a pure play capital. So equity becomes very vital in case of valuing a bank or a financial service company for that matter. Let me write this. So friends, equity based valuation becomes very vital for financial service companies simply because debt does not behave as a pure play capital resource. It behaves more like a raw material. So whatever valuation we do, it is much more defined or it is much more rational to use equity based valuation. So the two methods that we have spoken about which we can use till now are residual income method and dividend discount method. Also, we can use the valuation through free cash flow to equity. But here there is again a problem, friends. You will understand the problem when I write the expression for free cash flow to equity. Let me tell you. Free cash flow to equity is given by net income plus non-cash charges like depreciation and amortization minus increase in working capital expense minus increase in capital expense plus net debt. This is where the problem lies, friends. Why? Because again the same reason, debt here is not a capital. Here it is more like a raw material. So we cannot use this expression for free cash flow to equity. We cannot use this. So what we can use? We will use a different expression for free cash flow to equity, and then we will be able to use DCF through FCFE also. We will see it in a while. So friends, how we'll proceed with the valuation process? First, we will do the dividend discount model valuation, friends. Then we will understand what are the changes that we can make to the free cash flow to the equity to use it in valuation for a bank, and we will use that for the valuation of HDFC Bank. Then we will proceed to residual income valuation. These three things we will do sequentially for HDFC Bank right now. First, let us understand the dividend discount model valuation, how it is done. So friends, valuation through dividend discount model, this is given by value is equal to present value of dividends at year 1 plus present value of dividend at year 2 plus present value of dividend at year 3 till, let's say, the first 10 years, present value of dividends at year 10. These terms plus present value of terminal value of equity of the company. Now, how do we measure each of them? First, what we have to do, we have to find out a short-term growth rate which will define the 10-year dividend projections. This you will find out from existing net income and dividend payouts only. We will see how to do that. This will help us find out the projected dividends D1, D2, D3 till D10. Okay. And to find out the present values of these dividends, we'll need to find out the cost of equity. Cost of equity. How we'll find out the cost of equity, friends? Now the cost of equity you can find easily by using the Gordon growth model, friends. The Gordon growth model says price to book value is equal to return on equity minus growth rate divided by cost of equity minus growth rate. This growth rate is the perpetual growth rate, friends. Now for G, we will use the long-term growth rate. And the long-term growth rate that we will take here is the 10-year government bond rate. Or the risk-free rate, you can say in one way. So now we know what the G value will be in this expression, right? Now, if we know how to find out the price to book value and the return on equity, we can easily find the cost of equity, friends. So how we will consider the return on equity and price to book value? Obviously, we have a way to do that. What we'll do is, for calculating the cost of equity, we will take the return on equity of the top 15 banks and take out their average. So the average return on equity. So the average return on equity of the top 15 banks will be our return on equity value while calculating the cost of equity for HDFC Bank. How would we consider the price to book value? Again, we will take the average price to book of the top 15 banks. In this way, we will find out the cost of equity. Now, this cost of equity will be useful in calculating the present values. Present values of the dividends, present value of the terminal value also. And how would we calculate the terminal value, friends? The terminal value will be equal to net income at year 11 multiplied by 1 minus stable state payout ratio. We will learn what is the payout ratio and what is the stable state payout ratio in just a while. So net income at year 11 multiplied by 1 minus stable state payout ratio divided by cost of equity minus the long-term growth rate or the small g. Now let us understand what is stable state payout ratio and payout ratio. First, let us understand what is a payout ratio. Payout ratio is equal to dividend amount paid divided by the net income. So let's say if the net income in a certain year is 100 million and the dividend paid is 30 million, then the payout ratio becomes 30%. 30 divided by 100, right? And what is the stable state payout ratio? This is given by the long-term growth rate divided by the return on equity. This is the stable state payout ratio. So all these things we know how to calculate, and we will use those methods now in Excel and try to find out the value of HDFC Bank through dividend discount model, friends. So let's get on with it. So friends, we are starting off with the dividend discount model valuation for HDFC Bank. Okay. Now here the information that we will be using are payout ratio, net income, short-term growth. For the short-term growth rate, we will require the return on equity of HDFC Bank. Then we will also take out the average return on equity of top 15 banks, average price to book value of top 15 banks. These two will require for calculation of cost of equity. So here is the cost of equity. Apart from that, we also have the projected dividends here and the present value of dividends here. Cost of equity, growth rate, stable state payout ratio. These all information we will take out one by one and use them for projections, right? Now how we will project them? We will have a base year, that is year 0. And then we will have the projection for 10 years, 1, 2, 3, up till 10 years. And then we will calculate the terminal value at year 10 with the help of the long-term growth rate and the net income of year 10. Okay. So this is how we'll proceed. Now let's start with the calculations first. First, what we have to do is we have to find out the payout ratio. Here, so friends, here we are in the page of HDFC Bank. And if you see, the payout ratio is given here for last 11 years, March 2013 till March 2024. The payout ratio comes to be 19%, 19%, 19%, 18%, 18%, like this the numbers are given. So what we'll do is we'll take an average of it. You can see, friends, the average of these values comes to be 18%. 18%. So we'll take that value as the payout ratio. So 0.18. Net income base year. Net income base year is 65446 crores. 65446 crores. This is the base year net income. Now we have to project these numbers, these net incomes, and multiply with the respective payout ratios to get the dividend projections, right? So let's first find out the short-term growth rate so that we can find out the net income projections. Okay. Now here you can see it is mentioned Short-term growth rate is equal to return on equity multiplied by 1 minus the payout ratio. Okay. So return on equity for HDFC Bank is 22.1%. What we can do is we can take the average return on equity for last 10 years. The average return on equity for last 10 years is 18.1%. So we'll use this number, friends. 0.181. Now we are in a position to calculate the short-term growth rate. This is equal to return on equity multiplied by 1 minus the payout ratio. This is equal to 14.842. Now we will be able to project the net income, friends. Net income is equal to base year net income multiplied by 1 plus the short-term growth rate. Now we'll lock this number and we'll project it till year 10. Now we have the net income numbers, friends. These are our net income numbers. Naturally, we can also find out the projected dividends. So projected dividends is equal to net income multiplied by payout ratio. It is mentioned here, net income into payout ratio. This comes to be 13,528 crores till 47,000 crores, right? Approximately. So these are our dividends. Till year 10, these are the numbers. Now what we have to do, friends, we have to find out the average return on equity of top 15 banks and average PBV of top 15 banks so that we can move ahead with the cost of equity calculation. Otherwise, we will not be able to calculate the cost of equity or the present value of dividends, right? So let's do that. So friend, this is the data of the top 15 banks with respect to market capitalization. And here we have the return on equity numbers. The average you can see is 13.31. 13.31 is the return on equity. So we write that. So 0.1331 is the average return on equity. Average price to book value of top 15 banks. Again, we will take it from this data only. The average price to book is coming to be, so this is the column which has all the price to book values, and the average is coming to be 2.19667 approximately. So I can write this 2.19667. This is the average book value of the top 15 banks. Now we also need the long-term growth rate. Here we have mentioned the long-term growth rate as growth rate only. Let me write LTG here, long-term growth rate. So this is the 10-year government bond that we will be taking, 10-year government bond rate. Let me find out what that rate is. So right now it is saying that the yield is 6.963%. So let me use this number. 0.06936, right? Let me see again. 63. So this is the long-term growth rate number that we'll be using, and we'll be using to calculate the cost of equity and also the terminal value. Now friends, to find out the cost of equity, we have to rearrange this equation. So price to book value is equal to return on equity minus long-term growth rate divided by cost of equity minus long-term growth rate. We just need to rearrange this. So cost of equity minus G is equal to ROE by G by price to book value This implies cost of equity is equal to ROE minus G by price to book value plus G, right? This is our needed expression. So let us use it. So cost of equity is equal to average return on equity minus long-term growth rate divided by average price to book value, this whole expression plus long-term growth rate. This is coming to be 9.85% approximately. This is the cost of equity. Okay. Now we are in a position to find out the present value of dividends and also the terminal value. But before we do that, let us first find out the stable state payout ratio. This is equal to long-term growth rate divided by the return on equity of the bank. Now we just need to calculate the terminal value and then reduce the present values of all the dividends and the terminal value. So terminal value is equal to net income at year 11, which is equal to net income at year 10 multiplied by 1 plus the long-term growth rate. The long-term growth rate multiplied by 1 minus the stable state payout ratio. This entire expression divided by cost of equity minus long-term growth rate. This comes to be 59 trillion approximately, 59.48 trillion. Okay. So we need to find out the present values of the terminal value and the projected dividends. This is easy, friends. So we write here present value of the dividends and terminal value. So this is equal to dividend divided by 1 plus cost of equity to the power of the time. 1 plus cost of equity to the power of the time. And we project it. We project it till the 9th year. For the 10th year, what we do? We take the present value of the year 10 dividend and the terminal value both. So this is equal to sum of year 10 dividend plus the terminal value at year 10 divided by cost of equity minus long-term growth rate divided by 1 plus cost of equity to the power of the time. It is coming to be 23.42 trillion. So the present value of dividends and the terminal value, we have found it out. So let me mark it. Now how do we find the intrinsic value, friends? It's quite easy. Intrinsic value is equal to sum of all these numbers. This is the intrinsic value that we have, friends. 25.67 trillion. Now we have to find out the per share intrinsic value, right? So for that we need to find out first the number of shares. Number of shares. This is simply market cap divided by price per share. 12,71,431,1671. $12,71,431 divided by 1671. 761 crores approximately, right? Again, let me see, 12,71,431,1671. Therefore, the value per share, this is equal to total intrinsic value divided by number of shares. So this is coming to be 337.92. So this is our first valuation that we have done for a financial institute, friends. And let me just do this. Terminal value, let me put it here only. Okay, now this is the value or the intrinsic value per share found out through dividend discount model for HDFC Bank. Now the next method will be free cash flow to equity for HDFC Bank. Free cash flow to equity valuation for HDFC Bank. Let's first understand the theory behind it, then we'll come into the practicals. Free cash flow to equity valuation method for HDFC Bank. Now friends, we already said that we cannot use the usual expression of free cash flow to equity while valuing a bank. The usual expression was FCFE is equal to net income plus non-cash charges like depreciation and amortization minus increase in working capital expense minus increase in capital expense plus net debt. Because of this expression, the net debt, we cannot use this, right? We have to use some other expression. The other expression that we use here is free cash flow to equity is equal to net income minus reinvestments. Now, what is this reinvestment? We already know what is net income, right? What is this reinvestment, friends? The amount that you want to invest to maintain your capital adequacy ratio. Amount reinvested to maintain capital adequacy ratio. Okay, let's say a bank has, let's say at year 1, a bank has a loan book of 500 million. Now at year 2, it wants to increase its loan book from 500 million to 600 million. Again, let's say its capital adequacy ratio that it has to maintain according to its policy or the minimum requirement of the regulators, that is 20%. So it has to maintain 20% capital adequacy ratio. So if you have a loan book of 500 million, you have to keep an equity of 20% of 500 million. If you have a loan book of 600 million, your equity value should be 20% of 600 million. So the capital they have to maintain in year 1 is 100 million and capital they have to maintain in year 2 is 120 million, which means they have to reinvest 20 million in year 2, right? If they have actually expanded their loan book to 600 million, they will have to reinvest 20 million in the year 2 to maintain the capital adequacy, right? So if their net income in year 2 is 200 million, their reinvestment will be 20 million. Thereby their free cash flow to equity becomes 180 million. So this is how the reinvestment thing works. So 200 is the net income. The required reinvestment is the net increase in the capital adequacy requirement, right? This is the reinvestment, and net income minus the reinvestment is the free cash flow to equity. Okay. Now in practical terms, how we calculate it, we will understand in the Excel sheet. Now friends, in the financial reports of the bank, we can find something called the risk-weighted assets, and we can find something called the tier 1 capital. If we divide the tier 1 capital amount by risk-weighted assets, we get the capital adequacy ratio the bank is maintaining. And here we will assume that they want to maintain more or less the same amount of capital adequacy throughout the short and long term. Okay. And once we find out the capital adequacy required and we find out the expansion rate of the risk-weighted assets, we can also find out the reinvestment required, which implies we can also find out the free cash flow to equity of the bank. So we'll do that. So friends, from the annual reports, we found out that in 2023, the risk-weighted assets for HDFC was 15.86 trillion. For 2022, it was 13.53 trillion. And for 2021, it was 11.31 trillion approximately. So these were the risk-weighted assets. And the capital adequacy ratio, by comparing it with tier 1 capital, came to be 17.56%, 17.87%, 17.13%. So this was the capital adequacy ratio or percentage capital adequacy ratio that HDFC Bank is maintaining, right? the average of these numbers, these capital adequacy ratio numbers, comes to be 17.52%. You can see here, friends, 17.52%. So let us put here the number as 17.52%, 0.1752. And if you want to find out the growth rate of risk-weighted assets, this is equal to final number divided by the initial number, the root of these two numbers minus 1. So this is exactly what we have done. Final number, initial number, root of these two, that is 0.5 minus 1. And we have got a growth rate of 18.4367%. So this is, by the way, the risk-weighted asset value of 2023. We do not have the value of 2024. So we will use the growth rate to project the value of 2024 as the base year. Okay. So this is equal to 2023 number multiplied by 1 plus the growth rate. So let me write here the year numbers: 2021, 2022, 2023, so that we do not have any confusions here. Now we have the base year risk weighted assets, right? This is basically the proxy for the loan book expansion that we are talking about in the theory part, right? This is actually used in our calculation. Now base year multiplied by the growth rate, 1 plus 0.184367. And we will do one thing, we'll log this number and project the numbers here. So here we have projected the numbers from year 1 to 10. The capital adequacy ratio is 17.52%. So we can get the tier 1 capital requirement, which will basically help us find out the reinvestment required. So tier 1 capital is equal to CAR percent multiplied by risk weighted assets. So these are the numbers, friends. Tier 1 capital. These are all projections, right? Even the base year is a projection for us here. Therefore, the reinvestment required from year 1 to 10 is equal to increase in the required tier 1 capital. That is this year minus previous year. So we project it. Fantastic. We have got our reinvestment required numbers. So friends, what we'll do now is use the book equity and return on equity to get our projections of the net income. Now the current book equity is equal to number of shares multiplied by the current book value. Let me check what the current book value is. 519. This is the number, right? So let's use it, friends. 519. The book equity is approximately 3.94 trillion, right? And the return on equity, we can use the same return on equity that we used earlier for HDFC Bank. This is equal to 18.1%. Therefore, net income at year 1 is equal to 0.181 multiplied by the book equity. This is equal to 71.476.34, right? Now what is the book equity for year 2? This is equal to initial book equity plus reinvestments. This is 4.5 trillion approximately, and the return on equity remains the same. So net income here for year 2 is equal to book equity at year 1 multiplied by return on equity. So let us log this number. And what we'll do is we'll extend the book equity till year 10. Therefore, what we can do, we can extend the net income also likewise. Just to confirm, even the last year is net income at year 10 is equal to book equity at year 9 multiplied by return on equity. Okay. So we are in the right paths in terms of the calculation at least. So we have the net income numbers. We have the reinvestment required numbers, which makes it comfortable for us to calculate the free cash flow to equity. This is equal to net income minus reinvestments. So these are our numbers. Okay, friends. Now, how do you find out the terminal value here? The terminal value here is same formula. Net income at year 10 multiplied by the long-term growth rate 1 plus, we already have the long-term growth rate, I will not mention it here separately, multiplied by 1 minus the stable state payout ratio, this whole expression divided by cost of equity minus long-term growth rate. So we have our terminal value here, and we also have to do one thing, we have to calculate the present value of the terminal value, right? So we'll do it separately. Here let us write only terminal value. PV of FCFE and PV of terminal value. This is equal to free cash flow divided by 1 plus cost of equity to the power time. We project it till year 9, and likewise we did what we did in the dividend discount model, we'll do here also for year 10. So this is equal to FCFE at 10 plus terminal value at 10 divided by 1 plus cost of equity to the power 10. Cost of equity to the power time. So we have the present values also here. Now we are in a position to calculate the valuation through free cash flow to equity. This comes to be equal to sum of these numbers. So it's coming to be 26.25 trillion. Per share value is equal to valuation, total valuation divided by the number of shares. 3449. This is our value through free cash flow to equity. Fantastic. Now only one method remains, which is residual income valuation method. So let us first understand the theory, friends, of residual income valuation. Residual income valuation is basically the current book value plus the present value of all the excess earnings. Now, what is excess earnings, friends? Whatever earning is left after satisfying the cost of equity is the excess amount of earnings. I'll repeat again. Whatever earning is left as residual after covering the cost of equity is what is called the excess earnings. So let's say your return on equity is 15% and your book value is 100. This implies your earnings is 15, right? Per share it is 15. At the same time, let's say your cost of equity is 10%. That means to satisfy or to cover up the cost of equity, the earnings required is 10. Combining these two informations, your excess earnings comes to be 15 minus 10. This is 5. We are talking in terms of per share amount, right? Return on equity is 15%, book value is 100 per share. Cost of equity is 10%, which implies 15 minus 10 is your excess earnings, that is 5. So residual income valuation gives us a valuation in these terms, that the value is equal to current book value plus present value of all the excess earnings, sum of all future excess earnings. Now, if this goes up till infinity, this expression becomes book value multiplied by return on equity minus growth rate divided by cost of equity minus growth rate, which means the value becomes book value at 0 plus book value at 0 multiplied by return on equity at 1 minus long-term growth rate divided by cost of equity minus long-term growth rate. This is our expression, friends. Now obviously book value we know, return on equity we know, long-term growth rate we know, cost of equity we know. These all information we know. Therefore finding out the residual income valuation is not at all a problem, friends. So book value is 519 currently. Return on equity we have assumed to be 18.1%. Growth rate, we have calculated the long-term growth rate. It is 6.96% approximately. Cost of equity again we have found out. It is 9.85% approximately. Therefore, the residual income value is equal to book value at 0 plus again book value at 0 multiplied by return on equity at 1 minus long-term growth rate divided by cost of equity minus long-term growth rate. This entire expression. So this comes to be 2519. So because the book value we have taken is a per share value, the residual income valuation that is coming is also a per share value. So the value per share is equal to this only. Okay. So we do not need to separately find out the value per share here. 2519.469. So our valuations are complete here. So friends, this mostly concludes our valuation of HDFC Bank through the three methods: dividend discount, free cash flow to equity, and residual income. On retrospection, we had made a small correction. It is a very significant correction, in fact. While calculating the present values of the dividends, we had not locked the value of the cost of equity. Now we have locked it. So you can see any cell, the value of the cost of equity comes from the same cell, this one, right? So this has been corrected for the dividend discount model. Same mistake we repeated while calculating the first 9 years of present values for cash flows. Here also we have corrected it, we have locked the values. So these changes have resulted in slight alteration of the value per share in both the cases. Although these are small changes, the significance of it still remains very high, right? So we have changed it and made the corrections now. Now we are all right. So the last step is remaining, which is finding out the intrinsic value using all the three results. So what we'll do is we'll simply take an average of the three results. So this is equal to residual income valuation plus free cash flow to equity valuation plus dividend discount valuation, and the sum of it divided by 3. So we get the average of it. So the average value comes at 3062. This is the per share value of HDFC Bank. So now your assignment is to do the valuation of some other bank. It can be ICICI Bank, SBI, Kotak, any bank, and apply all these three methods and innovate in your own way if you want, and share the same with me. So you can do valuation of 1, 2 or 3 banks following this method.
So guys, try this assignment surely at home. If you come across doubts, share in the comments. I shall respond. For those who have enrolled to the internship, share your assignments on the mail ID given to you. The enrollment link is given in the description. Hope you enjoyed this video. If this video added value to you, please like the video and subscribe to the channel. Share this with a friend who is interested in finance and investing. See you in the next assignment.